Hello, everyone. My name is Hunter Smith with Metastock, and I'd like to welcome you to another one of our webinars today. We're going to be focusing on trading central banks and geopolitical risk. We have a very special guest here today. I'll introduce him in just a second, but before that, I have to get the legal stuff out of the way. This demonstration is designed to instruct you on using Metastock and accompanying software plugins, and is not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of our software, any trading strategies or information provided in connection with the company. All right, I got the legal stuff out of the way. Welcome to another wonderful webinar. It's, let's see here, about 2 p.m. on a beautiful Thursday afternoon in Salt Lake City, Utah. Like I said, we have a very special guest with us today, Mr. Richard Baily from Axia Futures. Richard, can you hear me okay?
I can hear you just fine, yep.
Wonderful. Now, Richard's been trading since 2008 across a broad range of futures markets. He started during the financial crisis, and he has an understanding of fundamental drivers and trading events that have been a key focus. Now, he teaches extensively at Axia Futures, which is a wonderful partner of ours. Richard, how are you doing today?
Not too bad, not too bad. We've had ECB today, so another central bank event. Unfortunately, not the most dramatic, but it did still provide a couple of reasonably typical opportunities. So not a bad day all round.
Well, good. I appreciate you staying up a little bit late for this webinar. You are in the UK, correct?
I am, right. So it's 9 p.m. over here, so not too late, fortunately.
Well, that's good. I'll tell you what, I won't take up any more of your time here. I'll just change the presenter over to you.
Lovely.
And I see your presentation.
You can see all the presentation.
Yes.
In that case, we will get started. Hopefully, guys, this will last around about 45 minutes, and then we'll have a bit of Q&A at the end. So any questions that come along the way, write them down, get them in at the end. I'll crack on because we've got quite a bit to do. I want to show you a few different trades that one of our traders has taken on. So you'll see the actual ladders, the trades being executed, a couple of very well-performed days. But the real takeaway from it, and particularly when looking at trading central banks, is what you learn from one to help you with the next. And it's always a constant learning curve. That's what we're trying to do a lot at Axia. We're trying to build traders up. We're trying to turn decent traders into elite performers. We're trying to take completely new guys and make them into decent traders. And so there's this constant growth. We're trying to do it slightly differently to other firms. There's not a case of throwing people in a deep end and seeing what happens. It's very much more a sort of collaborative thing. It doesn't matter how much experience you've got, you can always learn from someone new. So that's kind of more of our approach. Happy to share edges, happy to prepare events as a group. There's no sort of secrecy within Axia. And one of the biggest edges that we've got and has been cultivated over many years, not just starting with myself back in 2008, but a lot of traders have come through the 2008 crisis. We've then branched this out into geopolitical event trading. So it's not just central bank understanding, but we'll go perhaps more onto central banks today, focus on some of the execution there. Where some of the opportunities are. In terms of getting that news quick, Metastocks has been great for us. It's been one of the sort of key elements of building that edge up, that you have an edge in being able to trade these things, but then having an extra sort of speed edge that you can get from Metastocks, that's a massive help for us. So I'll show you a couple of excerpts from that as it pops up with some of the news as you see the trading going on. So why are central bank events so important for us? Well, unlike most people who try and step away from these events, the big advantage is there's so much increased volume and flow in these events, which means you're going to get more outsized moves. There's more people in the market. And so a market's then got greater potential. More people are in, more people are willing to trade, more people want to trade that event because it's possibly a complete change in policy. It's a complete change in where we're standing going forward in terms of the cost of money, particularly with a central bank. So these types of situations create these outside moves, and that provides a massive opportunity. The other upside to them as well is that you have more chance to prepare. If you're looking for a trade on a general day, perhaps a more technical trade, you're not going to be able to know whether that trade's going to play out at 9 a.m., whether that trade's going to play out at 3 p.m. Whereas with an event or a central bank event trade, you know when that event's coming. You can plan beforehand, you can sit down, get all your scenarios ready. So you know, come the moment, come that announcement, you know exactly what you're going to do. You're ready, you know what you're looking for. So as soon as that screen dump comes down on Metastocks, you know what to do. You've got certain trades planned out, and I'll go through a little bit of the sort of structure as to how you go about this, because so much of this is all about process and planning, doing your prep first. That's what makes the big difference. That means that come that moment of execution, there's no hesitation, there's no waiting to see what the market shows you or getting carried away with the flashing lights like you're in a casino. It's all about, you know what you're going to do, now's the chance to execute it. Also, you get paid a lot quicker on these opportunities. You'll see that in a couple of the videos that I show you, that a move that may well normally take 50 minutes, half an hour, even an hour, they can be over in moments, seconds even. And again, if you're ready for that, that means that you're able to be in, you're able to be out much quicker. And often a lot of trades do revolve around that speed of getting in, getting out. That's why the right software's helpful for you. And that's why that plan is so important as well. I'll give you a quick sort of example of a couple of things that have come up. These are the most recent things. And yeah, these events are turning around so fast. We started trading at Axia at post-Brexit. Well, Brexit was our first day of trading. And there's been tons of individual geopolitical events, central bank events since then. Most recent ones, though, we've had the Iran tensions. We'll have a YouTube video coming up there where our top event trader had his best day ever. So if you want to see someone make over $1 million, that will be up on YouTube in the coming days, weeks. But that was all about understanding what was going on, understanding the implications of that for gold, for oil, for S&P. You know, what markets were going to have the greatest moves on those type of events, and how are you going to take those trades on? You had to take this on the open. You know, this was a trade to be taken on that CME open in the middle of the night for us. So that was 11 o'clock in the night, on 11 o'clock on a Sunday night for us. But huge opportunity, and one that, you know, everyone's willing to stay there for. We had central bank events plenty in 2019, in particular the Fed and the ECB, notably December Fed. All about planning your scenarios. Yeah, it's all about knowing what's going to be important, what could change, and executing off those. We saw that at Sintra as well. This was an ECB conference where, again, changing policy, and that leads on to what we're going to have a look at in a moment. But the suggestion at that conference on the 18th of June last year was that the ECB was about to do something, that they were readying themselves to bring back QE, which meant you could now start getting prepped for the upcoming ECB meeting. And that's all about building narrative. One of the other narratives that's ebbed and flowed all year is the Trump trade deal. I've got a link there to another example of trading a specific event and various different sort of permutations of that event, and as the news pops up, as the news comes out and changes throughout the day. So go and check that out on YouTube. I'll drop that in the group at the end if people are unable to click on it just there. So they're just some of the more recent ones, but like I say, we've had tons of these throughout the last few years. So then we move on to, how do you actually trade these events? And So much of it, like I said, comes down to your preparation, to your planning. First up, you need a good understanding of what's going on, what I'd call narrative tracking. You need to understand how things are developing. Like I say, that press conference at Sintra from the ECB, that was the precursor to them starting to change rates, starting to bring back QE. We saw this with the Fed at the beginning of the year. They changed their language. They moved from a much more hawkish stance, where they still hiked rates at the end of 2018, to much more dovish. They brought in phrases like patience. Patience then disappeared, and they brought in the use of act as appropriate. So this was then up in the ante. This was saying that rather than them holding back and doing nothing on rates, they were now at a stage where they could act, and more likely this action was going to be a rate cut, which we'll also see in a little while. The other thing that's so important to track is market pricing. It may well be that in some cases you get no change, nothing happens, and yet because the market's already started to price an event, price a move in, that pricing then needs to be taken out. So understanding what the pricing means, understanding how a market's moved into an event, gives you a great clue as to where it could go on that event. So tracking that development, we're seeing it right at the moment. The Bank of England, who were quite prevalent as a central bank trade in 2017, and now once again coming to the fore. We've seen pricing for a rate cut for the Bank of England at the beginning of this month. You would think the market was pricing around about a 20% chance of a rate cut. We're now pushing over 60% chance. So the rate cut at the end of this month from the Bank of England does look much, much more likely. And there is a possible trade. Whether they cut or whether they don't, you may well have a trade there. If they don't cut now with the pricing that's happening, that's all got to get taken back out. That could see quite a bit of strength in the pound, perhaps. So understanding that narrative and knowing when something's going to become important. At the moment, we saw from the ECB today that they've pretty much given us the clue that nothing's going to be happening for some time. So until anything starts to change from them, we can assume that that narrative has gone quite stale. Also, data shifting. You know what the central banks are looking at, or you should know certain central banks have specific criteria that they look at, namely inflation for most. So if you start seeing that data shifting, or globally that data shifting in a certain direction, that then gives you a new narrative as well. And that then starts bringing up certain ideas. So once you've got your narrative going into the event, it's all about scenario planning. One of the worst things that I hear people say at the beginning of going into any kind of trading event is they'll say, I'm just going to wait for the market to show me. I'm just going to let the market calm down and then have a go. And if you've not got any sense as to what you're looking for when that screen dump comes down, all you're going to do is see the market jump around a bit and then make an excuse for getting involved because perhaps the market's gone down a little bit. And so you go, oh yeah, well, it's shown me it's going down. It hasn't. That's people just reacting to the different little pieces of news as they come down. So you need an actual clear-cut scenario. What's got to happen? What have you got to see on that Metastocks feed that says, now I'm going to sell it? Which means you don't get caught up in other people's opinions. And that's what happens if you're waiting. So having your own scenarios is so key. Understanding how they're communicated as well. And we'll talk about a couple of different phrases that come up at these decisions, particularly from the ECB and their use of present or lower. That was one of the phrases that they brought in July, and I'll show you that in a moment. So the use of that phrase relating to rates gives you a trade. You know that if they take part of that phrase away or put part of that phrase in, it's escalating the chance of them hiking or cutting rates. Likewise, the Fed moved from accommodative to patient to act as appropriate. This shift is suggesting that they're going to do something, that they're likely to cut rates. The other thing you need to do is prioritize your scenarios. Know what's more important, and we'll see this from the ECB in a moment. Finally, the most key thing here is then execution. You know what you're going to do. It's then about following through and executing that. The first thing with execution is understanding your technical landscape. So before each of the trading videos I show you, I'll show you some images of or some charts as to how the markets were setting up, what was important, which gives you a clue as to where that market can go or where that market's going to find it easier to go. The other side of your execution is understanding what the trade is. Is it a binary trade? Binary trade could be will they, won't they cut rates? And if they do, you know, if they do cut rates, you have a trade. If they don't cut rates, you have a trade. On something like that, you know that you can click instantly, where an interpretation trade that requires you to understand everything that's been said is perhaps a trade that's going to begin a little bit slower, that is then going to flow more on tone. So this then changes your urgency, your need to act. If it's a binary trade, it's going to be more of a smash and grab trade, and we'll talk about that in a moment. There's a couple of examples of this. Whereas a flow-based trade is more an interpretation and understanding of what language has been used, what that central banker is trying to say. Those types of trades often have a little bit more flow. Once that information is fully absorbed, then the market starts to move. And each of these is going to influence how much size you commit. Again, we'll see in a moment, one of our best event traders actually not committing the size that he should on a trade, and then the lessons learned from that as well. And that's the final stage. After those events, what lessons are you learning from it, and how are you then going to bring those into the next stages? So we'll start off by a look back at the ECB, and this is the ECB back in July. Now, like I said, in June, they'd suggested that they could well be moving towards a change in policy, moving towards possibly cutting rates. So areas that were coming up as potential moves. They're not expecting any change in policy, so we're not expecting any kind of rate cut. However, we've got a 36% chance priced in of a rate cut. So if the market doesn't, or if the ECB doesn't cut rates, that pricing's got to be taken away. It's going to be seen as quite a hawkish action. Therefore, you're going to see bonds falling. You're going to see the euro strengthening. So that's the first area. Next up, the language side of things. And this is where understanding language is so important. They could reintroduce their phrase that they've used previously, that rates will stay at present or lower levels. They've not used that for some time. They've just suggested that rates would stay at their present levels. And what they could also do is change their date guidance. So that the ECB was at this time suggesting that rates would stay at their present levels until summer 2019. They could change that again and change that language. So this is that bit about understanding the language, understanding their phrasing. They could use extended period. Other things they could do, possibly cut the deposit rate. That would align a little bit with the rate cut that's priced in, but still not fully aligned with it, so you'd still get a move. Change the inflation target is another option to make it easier to allow the inflation to rise further before they'll act. Another phrase that the ECB uses is to task committees and ask them to review, reevaluate, or reconsider their policy. In doing this, what they're suggesting is that they could well set the ball or set the wheels in motion to implement QE to cut rates at the next meeting. So it's a preemptive strike where they say this is what we're likely to do, so you're ready for that when it happens. Of course, always keep your outlier. Always know that there is one thing that could be the real big shock, and that's your biggest priority. That outlier was starting QE again. If they'd suggested at this meeting that they're going to restart QE, everything else doesn't matter. But in terms of priority, first trade, the first thing that comes out is your rates. So if they don't change rates, if they don't cut rates, you've got a hawkish move on your hands. Then it's a case of the interpretation side of moving into the language. So what we'll see now is a smash and grab trade on the rates. So rates don't change. You get a very quick action, get into the trade, and then we see a change as the rest of the news comes out. So I'll bring this one up for you. So what we've got here is various different ladders. The ones that you want to be focusing on, up here, you've got the Bund, which is our trader's main market. You've then got the Euro over here and DAX over here. Now, in terms of charting and where we are in these markets, I'll very quickly run you through. So this is where we are in the DAX. We've been pushing up towards highs. You've got recent highs up at around 12,590. We've moved above recent support down at 12,440, and you've then got a recent dip down to it at 12,470. So that's the main area that you want to be looking for. As long as we're staying above here, this market does still have a slight bullish nature. However, you get into this zone and start trading below 40s, you've then got scope for a larger move towards the downside. So this is that understanding the technical move. We're trying to push higher. If we fail to keep on going and then get down into this zone, that's where you've got a larger move coming. So already from a technical point of view, you've got certain trades planned out. From a Euro point of view, and what I've got here is I've got a Euro cash chart, because what's quite important about this is recent lows in the Euro on the cash coming at, excuse me, 111.11. Now, from a futures point of view, this looked lower. It looked like we'd already broken these lows, but that's not the case. And that's why it's so important to have a look at these cash charts as well. Something that I'm quite a big fan of. This is something I use MetaStocks for quite extensively, to understand where cash markets are as well, so that when you're trading futures, you don't get carried away thinking you've got through the significant level when you maybe perhaps haven't. What we've seen is this drift lower though, and this isn't a convincing drift lower because of the nature of this very steady, choppy type move down. What's happening here is people are getting short and getting forced into positions. So you've got the possibility of a short covering rally here if we get above 111.55, which is the equivalent of 112.03 in the futures. And finally, onto Bund. I've got a profile up over there, and what the profile is suggesting to you is that this market's getting exhausted. You've got tails up at highs, can't go any higher. Or every time it goes higher, it's getting rejected. Back onto the chart though, until we get below 174.51, the market does remain bullish. But again, you've got a big target down here, particularly the low of this most recent spike. Whoops, a few too many lines on there, which comes in at 173.85. So try and remember some of those levels. I'll talk you through them as we go on, or as we sort of pop up throughout the video. So let's crack on with the video and we'll see how these trades are executed. Right, so like I said, I've already put up the places that you want to be watching, and what we're going to see here is we're going to see market starting to move. There's your first part of the MetaStocks screen dump. So rates all stay unchanged. Quick action, jumps into the Bund, sells the Bund on that. What's really important here is you know that this is a trade where you're going to quickly enter on the fact that they're unchanged on rates. But the big change is the fact that they've given everything. They've suggested that they'll consider size and composition of potential net asset purchases. The Euro has stayed strong, and it's got into that zone where you could see this rally to the upside. Now, what you need to be thinking about here is people have jumped in on the first move on the rates. They're then going to get caught out, because the more important news is the fact that the ECB has suggested that it could start asset purchases. What you need to be thinking about here is where the moves all started. Once you get through those areas, that's then going to get people out. Anyone who sold it below the opening, or the opening part of that move, so in the Bund below 40s, is now in trouble if it gets back through 40. Therefore, they're going to start coming out of this trade. So this is why the position gets added to as you get back through 40. Now, at this point, the euro's still holding up. The DAX still hasn't turned either, so it's only the Bund that's going. This is where conviction comes in. This is where understanding your scenarios is so important. P&L getting very red there. We're down 25,000. So it's not looking like a great day at the moment. But understanding the importance of what they've said here, potential new asset purchases, overrides the fact that they haven't cut rates. When, yes, there was a chance that they would cut rates, but only a 30% chance. So now you're getting the euro dropping back down. Euro getting down towards where it started off at 87s. Bund still sitting up at 40. Now, for each of these, what you're looking for is you're then looking for the extreme of the day to get taken out. And this is where correlation becomes so important. Euro now back through scene of the crime. So the only thing that hasn't gone back through is starting price. That's the what phrase I use for scene of the crime. It's the starting price, where that activity started, is the DAX. DAX is now through it as well. So built the DAX position up now with 40 lots long in the DAX, 160 in the Bund. And what you're trying to do is just constantly scale. Each time the market flicks up, just scale in small size out just to reduce that position. And it also helps inform you as to where the market's pushing up to. If you're not getting filled, then it's showing you that that's the high of the recent little move. Now we're starting to see these moves develop, and now P&L is starting to turn around. The size is up to 430. This, of course, is a Euro stocks position as well that we can't see. Now, remember, your targets are up towards recent highs. So 66 for the Bund, 67 towards the low for the Euro. Getting a little bit of size coming in there. Crunched up, market trade straight the way through that size. That's pretty important. That's showing you that selling is still there. The DAX is the one market that's still not catching up here. So everything else is really pushing towards its extremes. The DAX extreme at the moment is still up at 89 for the day, and we're currently trading at 30. So we're 50 ticks shy of that high. So the focus is now the catch-up trade, and you can see the DAX starting to pick up pace here. Size is maintained as the Bund reaches its high. So tick, we've managed to achieve that. Size is still maintained in the Bund, but we're really waiting now to see the DAX get up towards those highs. Once it's there, that turnaround trade is complete, and that's where you can then start reducing the position. Bund falls back below the high or the previous high of the day, so position starts getting reduced back down to 100 lots now rather than the sort of 230 that we had. And finally, you're getting the DAX now pushing up towards highs. Everything else has got towards this extreme. This is the last market to do it. We're starting to see it now. Pushing up into the mid-70s. You'll see the high pop up. There you go. There's your high at 89. Just misses the high by a tick. This is now your chance to start reducing position. Bund's dropping back from the high. Euro's dropping back or pulling back from its low. That's where you start pulling it out of your position. Decent first trade. P&L's pretty good. We've gone from minus 25,000 to plus 170,000. So decent swing in P&L there. And it's then onwards to the next trade. And what we've then got is in the press conference, we then start to get the market turning back. Whilst they've suggested that they could do something, they've not suggested any timing here. And this is where we now start to see the trade turn. This is a tone thing. This market doesn't really believe that they're necessarily going to do anything. The way Draghi's speaking suggests that. The way he's not been willing to commit to anything suggests that as well. So we're now looking for the Bund to reverse this move. We've got above 66, 69 area. We're now looking for this reversal back towards that initial low. Previous lows of the day were down at 33 going into this, and then you're back down towards this target area of 80 to 60. Likewise, the euro, this was that grinding move down. We've had the whip down, so this is now on a futures chart, and we're looking for the move back up. So once you break this initial grind down, that's where the move starts from. You'll see the euro starts this move off and starts to kick in the other markets. The lesson to be taken here, though, is what we now see is a much more cautious attempt at getting this trade going. I'll speed this one up for a little bit. Where we saw initially moves taken on with a lot of size, 200 lots, 400 lots in Euro stocks, we're down to 90. So still quite a significant size position, but a lot more cautious in the entry, very quick to scale out, and scaling out in 10 lots here rather than in 2 lots. Euro's now already starting the turn. So we're starting up through 70 and it's pushing higher. It's picking up pace, but still we're not seeing this in the Bund. It's still quite steady and still quite cautious on the size. We now get down into a little zone here where we start trading between 50 and 60. And you'll see this. This is quite typical of a more interpretation type move, more of a tone type move. That the market drops into an area and then it will wait. It will sort of stall in an area. You start to get this range building up where you trade in a little zone as people sell on that initial sort of sense that they're not going to do anything, but then don't rush to keep selling. And that's the important difference there. People are going to be much more cautious here. I'll slow this down again for you. So we're back down. This is on normal speed now, though, so this is real-time speed. We get down into this 50 to 60 zone. And so what you're looking for here is, as we stabilize in this zone, looking at the other markets, so looking at your correlated market, in particular the euro, if that starts to continue to push, then we're looking for a move out of this zone. So below 50 or above 60. Above 60, you want to come out of the position. Below 50, then the next leg of the move is on. And that's what you're looking for here. For the next leg down to get you down towards 30 and then down towards 15s, which is the previous low of the day. So you can still see the euros, we've gone through 70 and we started to tick up towards 80s. We're looking up towards 112.03. You see the pace pick up here, and this is really important to understand when you're trading any of these type events. That little flurry of activity that we just saw around 55, 54 area is a suggestion that people are now starting to get active. The size starts to come down on the offers as well. That's helping. That's showing you that people really do want to start selling it. But the caution's still there. The reason for the caution is a very good performance on the first trade, on that smash and grab and reversal. And so there's an element of protection here, not wanting to get too sort of into the move and not wanting to get too much size on because of the fact that it's already done rather well on the day. So he doesn't want to sort of give too much of that away. So we're now sort of continuing to push on. We're through 50 and now a little bit more willingness to size this trade up. So very much playing for a breakout. Remember, previous lows of the day were 30. We then spiked down to 15 over the event. And we're starting now to push down. This is where once you get out of that little consolidation zone and everyone starts to realize that this market really is turning, you see the euro as well now pushing back up towards highs, back up towards 02s. This is now where we're looking for an exit down towards 30, but you could be looking, what's this pickup pace? We're already almost out of this. It's flashed down to 15 and straight back and completely out of that trade. So that was then the second trade to be taken. And this is where we're getting a bit more sort of interpretation based. You're going off the tone of the market as a much more steady type movement. We then get one final move down. And this gives you a good example of where to exit a trade. As you see another final flush, and each of these flushes is a chance to exit a trade. So what we're seeing now is after that initial drop to 15, we've then bounced back up towards that 40, 50 zone. We touched on 50 again. So that was the point that we consolidated and broke down from. That was this little zone here. Once we get back out of there, we're now falling and once again now having another consolidation before the next leg of the move. But at this point, look where the euro is. Euro is now trading up at 05s, 03s area. So already getting up towards the highs of the day. DAX is still not down into that important 12,470 area. So that's the key area for the DAX. We can get into that, but the euro is the one leading this. So this is now a chance to get into the Bund once more and to get on to the next leg of this move. So what you'll notice again, just like those 50s to 60s, is this little battle area around the 30s. Market's getting a little bit trapped around there. Euro's still pushing on. And as that euro surges through highs, that's what helps the next leg of the move. So it's just pushing up once again towards 10. Now we're right at the high in euro. And that's helping you out. That's helping you maintain conviction here. So if the euro pushes through highs, you can now expect the Bund to start moving lower. The DAX is also moving lower as well. And there we see it. Now the pace starts to pick up. You get a quick whip through 20s, very fast pullback again to 30 before the next leg of the move comes. So you got a little snap up, still maintain some position, but still cut it down. One of the key things with building a large position like this is to always reduce risk. You don't want to be carrying risk a long way offside. Once you're on, add to it, and you see that very aggressive add now straight up towards 280 lots into the lows. But if this starts to turn, you see immediately risk is reduced. That's one of the key things and one of the most important things that we've all learned from this trader over event type trades is if it starts to turn against you, out of it very, very quick. You can still add again. You can still be very aggressive on your second add, but you don't want to be carrying risk a long, long way up. We've seen, again, the DAX has now bounced from 70. So that was the point where you thought it would break. And the DAX has bounced. Euro stalling towards its highs as well. So, excuse me, this is a chance to reduce risk. Now the momentum starts to pick up again. Size is added once more. Quick to scale out, but only scaling in very small size. 2 lots scaling out of 150 lot position. Now it starts to pick up pace. We're through the recent low at 15 now. So we're now looking down to that zone that we had before towards 85 and 65. Pace picks up, still only scaling small bits of position out here. Just looking for the market to just keep on pushing down. And each little push down, it's just a chance to get out of some of that position. We're still seeing that Euro stopped the sort of surge higher. It's only now the DAX that's pushing on. So this then helps you give up, or not give up on the trade, but get out of the trade. The fact that the market that was helping lead this move is the one that's now stalling. But now down towards 85, 83 area, that was your key level to be looking for. Size now completely reduced down. Scale out of the move, take your profits. Now, it was very easy to look at that and think, well, that was a pretty perfect example of how to trade an event. But there's elements, there's things that you can learn from this, and it doesn't matter how long you've been trading and how proficient you seem to be, how much money you make on any event, there's a lesson to be learned here. And the big takeaway from this, and this is something that we always try and, when we go through any kind of mentoring sessions or talk through things with traders, how did they assess that information? How quick were they in understanding what came out of that screen dump? So, how quick did they just react off that first thing? A lot of those events are released in a certain order. As soon as those rates come down, do they just react off that and give up? And this is where recognizing that back through the scene of the crime and targeting the extremes of the day was a very good takeaway to try and hold on to those trades and committed to them. Where there's improvement to be had is that lack of commitment later on that flow-based trade. Much steadier, much slower trade, much, much less size, only one position. The big takeaways here is try and maintain that position whilst the tone remains. And also, if that move is grinding, to not sort of force your average price towards the low, which is something that he did get a little bit caught up with in trying to keep on selling the lows on momentum. Got himself a little bit stuck there. So we'll go and then and have a look at the Fed. The Fed came 5 days later. They too were at a situation where the market was now expecting a rate cut. But rather than just 125 basis points, there was actually a chance of 2 cuts, as in 50 basis points. So if they only do one, there's a smash and grab opportunity there, because the fact the market is still pricing some further cut. This is something that's always so key. Going back over previous events and things that were said from Powell and how they said it. So this was him at Congress, repeating that the Fed will act as appropriate. So this is where you go back through your meta stocks, you go and find those pieces of information and how they're phrased. So Fed will act as appropriate to sustain US growth. But one of the key things he said in this conference at Congress, there's a risk that weak inflation will be even more persistent than Fed currently anticipates. This is what gets the market thinking that there's going to be a further rate cut. Question then is, does this become the beginning of more rate cuts, or is this just an insurance cut, a short-term cut that they're going to do? Again, your outlier here and your high priority trade is the 50 basis point cut. That will trump everything else. In terms of charting situation, this is where we are in the euro. This was the ECB move. And from there, we've gone pretty much sideways. So that possibility of this short covering rally as we get back up above, excuse me, 111.60, 112.03 in the futures is still on. But more importantly, you've got a flag here. This was that cash low that was so important. Now, the futures were already showing that they're trading below there. Cash isn't, and that's going to be really key. If you can break this trend, that can then break that low on a cash point of view. So that's 11.56 in the futures. Get through that 111.11, and that's where the bigger move's going to start coming. So once again, the euro could well be your focus market here. It's got a greater scope to the downside. S&P is a bit even. We've been up towards record highs. We're now consolidating just below there between 20 and 10. What I'm always looking at on a market that's more range bound is where the next hurdle is. If we get out of this zone, where are you going to run to? 27 and then 01. If those break, then you can think about a bigger move, either into fresh space, into new record highs, or looking down towards 93 and this poorly traded zone, which could trade through quite easily. Now I'm aware of time, so I'm going to try and pick the pace up a little bit here. The gold and T-note both exhibit a similar thing, range bound and all stuck within the ECB range. So you've got a lot of hurdles to the downside. I've got the futures prices there to be looking out for. So what you'll see on the ladder, so 1434.9, 1429.5, 26.4 and 24.1. Likewise with the T-note. Again, you've got these extremes up at 27 and 01, which are going to be the areas to look for. So I'll quickly show you the first bit of action on this one. And this is the initial release of the data, the no change in rates. So there you go, there it comes out. Will act as appropriate, cuts target rate, but only cuts 25 basis points. So the first market to go for is gold. Then S&P. S&P's through 10s at this point. Gold's through 36s, which is the key area for gold to go for. This is a smash and grab trade. It's only a change in rate. It's not a great deal of anything else. They will act appropriate, so they've kept that phrase, and so they're not suggesting that they're going to be doing any more. Euro stalls very quickly. Huge orders sitting down at the low, down in the euro. So right at the point where it's about to break those key cash lows, you get major orders there. And that's because of that cash level. If you haven't looked at it on your cash chart, you won't be aware of it. You won't be ready to trade that. So still maintaining position, a long way on side in gold, so willing to hold on to the S&P trade a little bit. Got a good position there at the break of that little range through 10. So you're now looking down to 01s in the S&P. You're looking down to 29.5, so just below where we can see in gold. Euro's already starting to bounce. So that's starting to give you a little bit of clue already. The euro is the weakest one, or looked weakest going into it, and yet the euro is able to bounce here. The S&P is now pushing down, but you can see very quickly a lot of the energy is falling out of this. There doesn't seem to be that continuation in it. We've got through 10, so positions are now getting sort of scaled back a little bit. So coming out of that S&P one, not willing to sort of keep on pushing the position here, because of the fact this really is just a smash and grab. They've changed the rate, and that's around about it. So get in, get the S&P out of the box and start covering. Still managed to make a decent amount of money on this, but not sort of really pushing this trade. So that was your smash and grab element of the trade. What we're then going to go and have a look at is the next leg of this, and where what he's done is he's improved on that and learned from the lessons of previous. That now that the moves are starting to progress, it's now a chance to get a bigger bit of size on to really push this trade. You do get a quick break here, so you break those large orders. This spurs the next leg of the move, but very quickly again, that next leg of the move starts to dissipate and the market starts to turn back. So what I'll do now is I'll run you on to the final sort of leg of this move. So I'll just skip this forward a little bit. The one other thing that pops up in here, and this again creates a bit of movement as soon as it is said by Powell, but then also what you've got to be aware of is it hits the news wires, and that could be where a lot of people are reading it from. So you hear it, as soon as you see it hit the news wire, hit your meta stocks, you know others are going to act on it. You know other people have got this product, you know they're going to trade on it, and this then gets the next phase of the move. This reference to it's a mid-cycle cut suggests that they're not going to do any more. So the news is over, as in they are not going to change rates any further, and so therefore that gets your next leg of selling in. What's quite important to note here is that comment gets S&P through its lows. Gold can't get down to its lows there. So we'll move on towards the next element and the final part of the trade. So this is the last move that we get. And what we've now got is the markets have not turned on this. The tone is very much that they're not going to do any more. So we're now seeing the T-notes getting down towards the bottom of range, and this is where he's now committed much more size. We're now in 4 markets, 270 in T-note, 98 in euro. This is actually 120 in gold, 120 in S&P, and going on that sort of strategy of not exiting, and you're not seeing this very quick sort of flurry of orders to get out this time. This is because the sentiment's there, that tone is still there, that this is a mid-cycle cut, that they're not going to do any more. So it's about building that position up and then letting that position play out. So we've now got the euros now 40 ticks through that key daily low, pushing down towards 111.00s. Gold also below 29.5. So the next level you're looking for, 26.5 to get down towards 24. Now, because gold's more range bound, if this can get the 20 ticks further on, that's where you can start to get in your position out. Likewise, T-note targets down at 01. That's where you want to exit this trade. It's the S&P now at this point and the euro that are the ones that have got the greater scope to actually push on here. What you'll start noticing, if you watch the euro in particular around this zone, this is the weakest market. This is the one that's been weaker all along, and it's now starting to stall. Other markets are still pushing on. You're still seeing the T-note down towards 07, so the T-note's still breaking lower. Gold is still pushing down towards 26, and what you want to see here, and what you'll see in a moment, is another add of positions to try and get the break through those 1426s and a continuation down towards 1424. So positions are still maintained, still got 120 gold, still got 180 T-note. S&P is the only thing that's really getting scaled out here, and still looking for this euro to then break through 11. So next attempt at breaking the low in gold. And again, we've learned from that lesson to try not to let the market rotate or try not to suck your average price down by selling too low to maintain the position through these moves. So it's now just a case of sitting and waiting. The euro position's getting reduced because still, again, this market is holding and holding and holding. Everything else has kept going here and the euro hasn't. There's your gold flush down. And whenever you get that fast flush, that's a chance to exit your trade. So you now see the position getting reduced in gold, position getting reduced in S&P down to 26 lots. Tino as well, down towards 03 to 01 is the area to try and get out of this. And that's where we're getting down to. People are starting to get out of their positions here. S&P starting to have a little bit of bounce. Euro still no movement. Cannot get through 111.10, 111.06 area. We now get gold down towards 24. Quick flash through towards 22 and very, very fast reversal. You'll see the same in the S&P in a moment, and gold's already starting to give you that clue. So gold's completed the move to the bottom of the range. T-note's now completed the move to the bottom of the range. Both positions are getting scaled back. S&P is trading around 69, 70s. So everything else is now starting to reversal up. Gold up, T-note moving up, euro moving up, S&P still going. Scaling out of the euro position, the gold position now as well, quite quick scaling out. You see this position's really getting smaller and smaller. S&P is still going, and this is where you have a reversal potential. You start looking at this thinking this has gone too far. Everything else is turning. Yes, the S&P was weak going into this, or had the potential to be weak going into this once it broke through 01s. But the fact that everything else is already bouncing now should be an indication that this has gone, I don't like to use the phrase too far, but you should be aware of a bounce coming in the S&P. So positions have now been well reduced, but the key takeaway there and the key lesson from the ECB was that once that second wave of flow comes in, to get your positions on and hold them and scale them out in a much slower manner. Now you're seeing that S&P rally, you're seeing that pace pick up, jumps very quick from 58s, we're trading 65s. Euro still holding down at lows, but still sort of pushing away from the 11s. T-notes retraced somewhat. Gold also $4, $4 off its low now. And we're seeing everything start to reverse. But the key bit here is the fact that he's held that trade and held those positions means that, yes, some of them came out a little bit off the low, but you were able to get out the majority of it very close to the low and a much, much more improved P&L. So it's all about working on those takeaways, working on what you learn from each one. It doesn't matter how long you've been in this game. That constant ability to adapt, that constant willingness to learn every single time is what then takes your performance up, and it's what helps other people. We're constantly sharing ideas on these types of things, and that's what's so important. So I'm going to wrap it up there, guys. Hopefully that's given you a little bit of insight into trading central banks, into some of the tools that we use, in particular for the news side of things, and understanding the cash side of markets as well. What I'll do, I'll open it up to some questions. So if anyone has got any questions, do quickly get them up. If not, you can always email them to me, send them at richard@axiafutures.com. That way I'll be able to answer them if something comes up a little bit later on. But on that note, I'll wait until there's any questions. Main thing to say is thank you to Hunter for having me on, letting us sort of present some of our ideas. And thanks Metastocks for the news feed, for the speed with which some of this data comes down. It has been a great edge for us. So thank you very much, and do follow either of those links if you want to follow up. And like I say, if you want to see someone make over £1 million in a day, that will be coming up on our YouTube channel soon. So questions welcome. I believe I'll be handing it back to Hunter now. So thanks again.
Yeah, sounds great. I'll leave your screen up here for just a second.
Okay, lovely.
While the questions come in. First question.
Sure.
Do your traders always do multiple markets in an event?
It varies by trader. Most of the time, most people will have a preferred market or a market that they're most comfortable in. Most people will have a market that they typically trade, and that will be their go-to market. But a lot of the trading other markets comes down to that technical view that if you've got a market that's got a great deal of scope to the upside, even if it's perhaps not your core market, that would then be one to trade. I'll give you the example of gold over the Iran story. On that first move higher, that first break higher in gold, it was actually breaking over recent highs and up to levels that it had not been at for quite a considerable amount of time. And so that then meant that the chance of that going much, much quicker and much higher was so much greater. And so gold then became the bigger opportunity. I'll bring you in a chart of gold very quickly here. And so this was the move over that Iran comment. And because you were getting up to levels that we hadn't seen since perhaps even back as far as 2010, gold was one that was going to have a little bit more scope for it, even though that may not have been everyone's main market. So it's your understanding of other markets and technical structures that's going to then help people or give people more than one market to trade. That's that trader's specific skill of going into numerous markets and then using each market to try and understand the correlation between what's going on. So that if you, like I mentioned a couple of times, the euro was giving you the clues and that was enabling you to then stay in other positions. So part of it is a greater sense of what's going on by having a position. Other times it is a case of just understanding the current situation in the market and where that greater move is going to come from. So hopefully that's answered that question.
Perfect. Let's see. Looking for another question here. What news service are you using? I'll take this one. He's actually using Metastock Zenith. I'll cover kind of how to get that news service here in just a second. But the news service he was using, as well as, for example, the chart you just saw, that is all under Metastock Zenith. Actually a platform that was built for the professional traders at the cost of about $1 billion, and we were able to secure a retail version of that for retail traders. Next question coming in. Let's see. Do you use any technical indicators?
I'm not a huge fan of specific indicators. From a personal point of view, I'm more a chartist. I'm more sort of interested in chart patterns, in sort of developing a picture as to where a market's going, and looking at how, say, a move's developed and how that gives you a little bit more sense of the scope of a market. So what I mean by that is in certain situations, you're going to find it easier to get a certain type of move. If we go back, I'll bring you up a Bund yield chart. And if you go back to that July move, that was just down here. And this was, at the time, the lowest that we'd ever seen yields in Bunds. And so that market, whilst it was looking like we were moving up in the future space, the yields were then approaching record low levels. And what that meant is that there was a greater possibility of a bounce. And so for a yields to bounce, you're going to be looking at the Bund futures actually falling, and that's what you got here, and that's what created that whip back up. Once it breaks, then you see yields fall further, and that's a case of the yields are falling as the price is rising. So for me, it's more about the sort of technical picture charting patterns. I'll use profile a fair bit as well. But specific indicators I'm slightly less keen on. I do like Fibonacci. I think Fibonacci's on very quick, direct moves are helpful. It really comes down person to person. I know the trader that we saw up there on the screen just then, he's quite a big fan of using moving averages. a moving average to help you stay in a trade. So using, for example, a very short-term exponential moving average, so that once you're in, as long as the market's staying below or above that moving average, so say you're on an up move, market stays above that, you'll stay in whilst you remain above that moving average. So personally, I'm not a big user of indicators, but there are, it varies person to person.
Sure. Yeah, and that's a great answer.
Thank you.
It really does, and the tightrope that we walk is providing tools that will work for any type of trader. Even if you're using minimal charting tools, minimal indicators, you have the news feed, et cetera, to back you up. Now, do we have any questions from YouTube at all? Just checking here. Okay. Let's see here. Just checking to see if we have any other questions. There was a question about the Fibonacci's. What specifically do you use in Fibonacci's?
So as in the specific levels?
I think he's asking levels. TD, if you could clarify your question in the chat box, that would be great. If it's just Fibonacci levels or how interpretation, what are we looking at here?
Okay, so for me, with a Fibonacci, what I'm not someone who's going to try and use them over particularly complex moves. I think they're better used for a very direct move. So on an event, let's say, you get a much clearer sort of picture that you know where the main bit of the move has come from, for example. So once you know where that main bit of the move is, that's where you can then start looking for the retracements within that move. So what you're trying to get is, rather than looking at the sort of a move that is not clear where the swing high, swing low of that move is, what you're looking for is, let's see if I can give you a little bit of an example here. I wouldn't be looking at, say, for example, a Fibonacci of this move here, because I think it's quite complex in whether you could draw it from here to here, whether you draw it from here to towards the recent highs. More what I'm looking for is, over an event, if you get a very sudden piece of action, a very sudden quick move, that's the bit of the move that what you're trying to do is you're trying to use the Fibonacci to get on a pullback of the move. So that would be the bit that I'm looking for. So the 38.2, the 618 are the main two that I'm going to be looking for. And what I'm going to be using it for is to try and get myself into a move once that move started. So say you get that very first fast impulse part of the move. Once that's happened, you're then using the Fibonacci to try and get on a pullback for a continuation, aiming towards the top of the move. So I'm generally using them on shorter time charts, and then looking for, like I say, 38 or the 61. And the other thing that I'm quite keen on is making sure that lines up with something. I'm not going to arbitrarily just say, right, I'm going to trade off the 38 fib. It's going to be a case of, if that lines up with a previous level, previous high, previous low, that's when I've got greater conviction. So a lot of it's about improving your conviction of a level, as opposed to just picking the 38 or the 61, for example.
Now, do you look at pivots as far as once it reaches a fib level? Are you looking at pivots at all?
As in pivot points?
Correct, yeah, pivot pattern point.
I don't. I know there's a few people who do, and that again would be something that I think with any kind of indicator like a pivot or a Fibonacci, a lot of it is about understanding whether other people are looking at that. So say, for example, you start noticing that people are reacting to a pivot point, then if a Fibonacci lines up with that, what that's telling you is those who are looking at Fibonacci are going to be looking at that level. Those who are looking at pivot points are going to be looking at that level. So therefore, you've got more people who are likely to trade in a certain direction. So whilst I don't use pivot points specifically, recognizing that other people do is an additional help, particularly if you're trying to put a couple of things together. if you're seeing that pivot points aren't working, the market's not holding those, then I'm not going to use that as a reason to then couple it with, say, a Fibonacci level.
Sure.
So a lot of it's about building greater reason that, perhaps a technical level that I'm already looking at is going to be something that's going to work.
Okay.
So that, I think's where it works a little bit better.
Wonderful. Well, what I'm going to do here is I wanted to cover a couple of the ways that you can actually take advantage of the tools, some of the tools that we saw here today. What we've done with Axia is we have taken a lot of their methodologies, a lot of the same exact tools that they use, etc., and we've created workspaces around that within Zenith. And there's a very, very easy way to take advantage of this, and I'll show you the website here in just a second. The link is on your screen. I've also put it in the chat box, both on GoTo as well as it will be in the YouTube for those of you that are on the YouTube side. But all you have to do is you go to metastock.com/Axia 3for1, 3FOR1, and it will allow you to get basically an extended trial of Metastock Zenith. Now, this was the majority of the tools that Richard was using today. Normally, this is $150 per month. For Axia customers and clients, people that have watched this webinar, what we're going to do is we're going to provide you an extended trial where if you pay for 1 month, you get the second and third month for free. So you end up saving about $300. And within 3 months, we also throw in some training, etc. Within 3 months, you're going to understand how this is going to positively affect your trading. Now, along with Zenith, what we wanted to do is include these workspaces. Now let me pull up the correct screen here. Give me just a second. So if you go to metastock.com/Axia install, you can actually get the trial from here as well. But this video is going to pop up, and a person with just an amazing heavenly voice is talking to you in this webinar, and he's actually going to show you how to get these templates and how to actually install these templates on Zenith. This walks you straight through step by step what you need. If you go to metastock.com/Axia install, about halfway down the page, they'll actually give you there'll be a link so that you can take advantage of Metastock Zenith and that extended trial. And if you have any questions, feel free. We're always here if you need us. In summation, I don't think we have any other questions. Richard, you did a wonderful job today, making something very complicated seem very, very simple. So hopefully that helps you all out in the audience.
Well, hopefully that's helped quite a bit. Yeah, that's something I really try and do, so try and make it a little bit more accessible. I'm actually doing, or will soon be releasing, a central bank course as well. So there'll be a standalone course on the Axia website where you can learn more about the function of central banks and specifics of how we trade them, and a little bit more detail on how we use Zenith as well for that.
Wonderful.
So look out for that. Keep your eyes on the website for that.
And that's axiafutures.com, correct?
That's right, yep.
Wonderful. Now back on the screen, if any of you in the audience need these links, feel free to type those in. We also have people in support chat through metastock.com that can assist you with that. Just mention you're in the webinar. Again, Richard, thank you so much for the presentation. Thank you for staying up late and being with us this evening.
Not a problem. It's been a joy.
Wonderful. Those of you in the audience, thanks so much for being here with us today. We appreciate your time. We hope you learned a little bit. Feel free to go to metastock.com/Axia 3for1 or Axia install and get some of the tools that you saw today. And as always, happy trading.